Okay, thank you all for coming. I just want to read out the acknowledgement of country. UTS Business School respectfully acknowledges that we are located on the land of the Gadigal people of the Eora Nation. The Gadigal people have cared for their community, land and waters for thousands of generations based on their deep knowledge of their country. We pay our respects to their ancestors, their elders, and acknowledge their ongoing status as the first peoples of this land. Thank you. Today is the inaugural UTS Accounting Discipline Group webinar. So again, thank you for coming. It's, I think, very timely with the budget coming up in a few weeks, and we will mainly discuss the corporate tax policy initiatives that sort of promised last year as part of the election, and we'll be looking at what's happened since, and I suspect a lot of these measures will be part of the budget in a few weeks. So we'll take it from there. Our panel members for today, I am the host. My name is Roman. We also have Jason, whom I've known for quite a long time, for I'd say probably over 10 years at least, whom we have worked with on many different projects. And Jason is a private consultant who deals in corporate tax avoidance issues, has done many submissions, done a lot of his own research as well. And for someone who didn't know much about accounting 10, 15 years ago, he probably knows more than certain accountants. We also have, so Jason is on Zoom. We also have Ross, who's next to me there, my former PhD student. He's done a lot of research in the area. He's also worked with me on many different projects and with Jason. So he knows quite a bit about the area, especially the PRRT, which he will hopefully talk about today. And finally, we have Bronwyn Mccredie. She's also an academic from QUT. She has a big interest in the area of tax and tax avoidance, and has written some things recently, and I presume will continue to do so. She is also starting a special interest group as part of the AFANS conference or association, which is the Australian New Zealand Accounting and Finance Association. So thank you, Bronwyn. All right, so I think the format will be, and we have Sue as well. Thank you, Sue. She's our head of discipline. Before I do start on the discussion, again, as I said, this is our inaugural webinar. Hopefully first of many. The point of these basically is for the ADG, or the Accounting Discipline Group, to engage with the community, that is everyone out there, in terms of research topics, any topics of interest to the community, and to really, get some dialogue going between us and the community, to start any interesting projects. Any of you guys out there, you do have ideas for webinars, we're happy, please contact me. We do have plans to put on at least another 3 to 5 webinars by the end of the year. So please stay tuned, or just have a look on our website. That will be advertised as soon as we have more concrete plans. But really, the aim, again, as I said, is to engage with the community, that is you guys out there, and hopefully begin some sort of collaborations as well. External engagement is part of our service, which I think a lot of people in the community are not actually aware of. But that's part of our job. And we'd love to discuss any sort of, topical issues that are of concern to the community at large. I don't know, Sue, did you want to add something about what our engagement objectives are? As the head of school, you don't have to, but I don't know, I presume I've said enough. No? Okay. All right, well, let's begin. So the aim of today, as we advertised, is to basically discuss, and it's a very timely webinar, I think, with the budget, as I said, coming up in a few weeks, is to discuss some of the corporate tax avoidance policy. And I think this is going to be a very exciting year because there's a lot of things in the pipework for the government. And exciting as well because the panel members, in particular myself, Jason, Ross and Bronwyn, we've been advocating for these things, I think, for at least a decade, have been working on these things, Jason on submissions and us together on various industry research projects. We've done, we've gone to the Senate hearings and provided evidence at those hearings. So it's great to see that some of this stuff is actually hopefully coming to fruition. Last year, Labor, as part of their multinational tax integrity package, just before the election, released a few things. It was a bit vague then before the election, as I think a lot of things are, but I think they provided a lot more detail on what they were trying to do in the October budget last year. And in fact, I think what's happening now is probably before the budget, and I think these things are timely. Treasury is actually releasing the draft legislation and some during the consultation time. And look, I suspect maybe hopefully a lot of these things will be actually costed and will be in the budget as well in May, in a few weeks. So I think it's a very, very timely discussion. And I think, you know, it's good for us to have it at this stage. What I'll do is I will ask a couple of questions of our panel members. They can, you know, if possible, let's just give them 5-10 minutes to talk about these issues. Then I'm happy to open it up to the audience if you guys have any questions of them. Obviously, if there is time at the end as well, you can ask us whatever you like. But what I might do is the first question I'll put forward is to Jason Ward. As I said, we have worked with Jason many, many years. And Jason is probably the most active out of the panel because Jason actually does this pretty much for a living together with the Tax Justice Network, through his own consulting firm there. He's got it there in the background. He puts in submissions. He on a consistent basis meets with the ATO, with a lot of other stakeholders, NGOs, so on and so forth. So he is probably one of the most knowledgeable, I'd say, people in Australia in terms of, you know, what corporate tax policy initiatives are in play, what's likely to actually, you know, be put forward by the government and actually make it finally into legislation. So, Jason, how about, if you can, if you don't mind, just summarize for us, you know, some of the initiatives during the election and how they took, you know, they were solidified with the budget last year in October, what's been happening and what's actually now on literally almost on the books with the draft legislation there. So I'll pass it over to you. I'll give you 5 to 10 minutes to say it, and then obviously anyone who's got questions. It's pretty much an open meeting, so anyone who's got questions for you, they can ask you after that. Thanks, Jason.
Sure, thank you, Roman. And just to clarify, so my organization is CICTAR, the Center for International Corporate Tax Accountability and Research. We don't do consulting, but we're now officially registered in the UK as a company limited by guarantee, a nonprofit organization. And we do a lot of work with partners in Australia and all around the world. We do a lot of work with trade unions. We try to bring trade unions into the push for tax reform at the national and global levels. So I'm very excited about what has transpired. And as Roman indicated, this is sort of flows from election promises, flows from October's budget last year, and then flows from a Treasury consultation that was put out last year in, I think, October, September. So at the moment, we've had 4 pieces of draft legislation that Treasury has published, and the consultation period for the last of those 4 ends on Friday. So we've got 4 pieces of draft legislation that are out there now. So they are, I'll go in reverse order. Public country by country reporting is the one that closes on Friday, and the most recent one, and the one that I think has the most potential and sets a new global standard. It may not have immediate revenue consequences in Australia, but it is globally significant, and I can come back to that. The other one, which I think the submission may have just closed, is relates to deductions for royalties or intangibles, a frequent tool used by companies to reduce their tax liabilities in Australia and in other countries around the world. So there's new legislation that will restrict the use of payments, related party payments for royalties or intangibles to jurisdictions or places with a low effective tax rate. So we're quite excited about that one. There's some tinkering around FinCap or related party, offshore related party debt as well. So that's just kind of tightening the existing rules that are, I think, already pretty good since the Chevron decision in 2017, which put new practical compliance guidelines in place for that. And the 4th piece is requires all Australian public companies to disclose all of their subsidiaries and the jurisdictions in which those subsidiaries are tax resident or incorporated. So that is a significant step forward, applying only to Australian public companies, listed and non-listed. That kind of matches the standard that exists in the UK. So we're very happy to see that as a simple, common sense reform coming into place. There's a 4th piece, which I'll just touch on, which is not part of this package, which there's been some noise about in recent days, which I'm quite excited about, which is continuing reforms to the petroleum resource rent tax, long overdue, and stalled in a Treasury consultation for about 3 years, and that's following the Callahan PRRT review, which Treasurer Scott Morrison kicked off in 2016. So those reforms are a very long time coming. And that, I think the most promising there is a simple common sense reform relating to the gas transfer pricing mechanism, or how the gas, the raw gas, is priced within the PRRT system. At the time of the Callahan review in 2016, that was estimated to increase revenues by about 90 billion over a decade. I think more current estimates are suggesting that in the short term, we're looking at $3 billion of revenue per year from the offshore oil gas industry, which currently pays nothing in terms of royalties for the gas that it extracts, and that has made Australia the world's largest exporter of LNG, liquefied natural gas. So very excited about that. I'm just going to come back very briefly, if I can, to the public country by country reporting. Multinationals in Australia and around the world have been reporting for a number of years under the OECD rules, but that reporting is confidential and restricted to tax authorities only. This is the first time anywhere in the world that we'll have a government requiring public country by country reporting. And it's following the GRI tax standard, the Global Reporting Initiative tax standard, which was developed by an expert panel and widely consulted in 2019. My organization with allies helped to get global investors with $10 trillion in assets under management to demand that be part of the GRI tax standard, public country by country reporting. It's a bit more robust than the OECD standard and designed for public consumption. So this is a huge increase in transparency and is relevant globally, because anybody anywhere in the world, particularly tax authorities in the global south that don't have access to the OECD information, will be able to look at how much multinationals pay, so long as they operate in Australia, how much they pay or don't pay in every country in the world in which they operate, and other basic financial information will be required as well. The number of workers and various descriptions of profits, losses, and related party transactions. And we've had a lot of investor activity around this issue, demanding greater transparency, because at the moment, investors in a company, say an Amazon or a Microsoft, are completely in the dark as to what its operations are and how it functions, both on a tax basis and a broader economic basis in countries outside of the United States, because they report on the US as one and the rest of the world generally as a lump sum. So this will force them to disaggregate information, basic financial information, tax, revenue, profits, losses, numbers of workers, etc., on a country by country basis. So we finally, I agree with some of the world's largest corporate lobbyists for the IT industry, who are now saying that what we need is global consistency. And I couldn't agree more, and hoping that other jurisdictions will immediately follow Australia's example and use the GRI tax standard as the means for requiring public country by country reporting for all multinationals. I'll stop rambling right there.
Thank you, Jason, but I'll disagree with you on one thing. I think the measures you mentioned, you could probably put them into two baskets, and we sort of knew that during the election promises. We didn't know exactly, but they are transparency measures on the one hand, and actual changes to tax rules. So where I disagree with you is those transparency measures, they will have revenue implications. It's hard to quantify, but that's the whole point, because, as you know, we've done research which suggests transparency could probably work even better than rule changes or specific rule changes in making corporates actually pay more tax or do less tax avoidance. So what I might do, guys, is I might just pass on straight to Bronwyn, because she will have to leave at 6 o'clock. The reason being, maybe we can come back to Jason a bit later, because Jason does have a lot of stories. But what I'm going to do now is I'm going to ask Bronwyn and then Ross a couple of questions specifically in relation to these measures that Jason has mentioned. So, Bronwyn, I think Jason has given us a very plain English sort of a view of country by country, or the public version of it that hopefully we'll have in Australia. And there are sort of public versions of it in Europe. But can you give us a bit more of maybe a bit more of a technical and a more of an academic overview of what it is, why we need it, and possibly, where it can bring in more revenues, etc.
Okay. Can everyone hear me? And am I fine? Great. Excellent. Okay. So thank you very much for the invitation to come along today and talk to you about this. In terms of tax policy, and particular tax policy in Australia, we've taken one of a global approach in recent years, with jurisdictions debating significant changes to international tax rules affecting multinational companies. So, for example, we had the OECD BEPS program, and more recently, we've been talking about Pillar 1 and Pillar 2. Now, Australia is a significant contributor to the work of the OECD, and it arguably maintains its status as a leader of tax policy through domestic policy initiatives, such as the ones that Jason's just been speaking about. So as we know, in the 2022-23 budget, the Australian government took strides towards one of their election commitments and proposed the multinational tax integrity package associated with improved tax transparency. Now, that sought to impose, amongst other things, public country-by-country reporting on multinational entities. Now, this proposal has now been operationalised in a recent exposure draft, which was named the Taxation Laws Amendment Measures for Futures Bill of 2023, and it was issued on the 5th of April 2023, and it is due to close for consultation, as Jason said, on this Friday, the 28th of the 4th. So it is landmark legislation. It has been touted as a world first in corporate tax transparency, and it's been applauded worldwide by transparency advocates as a call to action for other jurisdictions. So the Tax Justice Network, SICTA, and the FACT Coalition, among others. So what does the legislation in fact call for? So specifically, public country-by-country reporting will require Australian resident constitutional corporations, which are financial or trading corporations formed in Australia or a foreign corporation. What we also call country-by-country reporting parents and subsidiaries, to report key financial information for every jurisdiction that they operate in, including the names of each entity in the country-by-country reporting group, a description of the country-by-country reporting group's approach to tax, a description of their main business activities, the number of employees that they have at the end of the year, revenue related to unrelated parties or revenue from unrelated parties, revenue from related parties, expenses arising from transactions with related parties, profit and loss before income tax. They have to provide a list of tangible and intangible assets at the end of the financial year and the book value of those assets. They have to include income tax paid, income tax accrued, an effective tax rate, which I'm not completely sure is the right approach, which I'll allude to in a minute, and a reason for any difference between income tax accrued and the amount of income tax due, and finally the currency they're using to calculate all of this information. So obviously this is a huge step towards lifting the corporate veil and addressing multinational tax avoidance. But the question still remains, does it go far enough? So in research that I've completed with two colleagues, Professor Kerry Sadek and Professor Rick Creever, on the Tax Transparency Code, which is a voluntary disclosure regime in Australia, greater transparency does not always equal better information. So what I'm saying by that is more information does not always equal relevant, robust, verifiable, and comparable information. And we certainly can't assume that the provision of this additional information is going to make a significant difference to the behaviour or the tax behaviour of companies. Importantly, the issue that still remains in country-by-country reporting is that the information provided does not go deep enough, so it's not detailed enough. For example, if we're trying to identify corporate tax avoidance or tax aggressive behaviour, the figures that will be published in country-by-country reporting, so things like revenue, expenses, profits and losses, are net of tax aggressive behaviours, which are typically wrangled or perpetrated through transfer pricing, loan agreements, or an impressive suite of other methods or other arrangements. Now, the effects of these transactions are already embedded or hidden in the figures, so in profits and losses, in revenues and expenses. So we won't be able to determine with accuracy the occurrence and the extent of these transactions. Of course, we can try, as we have been trying to date, by formulating proxies. But recent work that I've done on looking at these proxies, measures of tax aggressiveness, reveal that they have limitations. Now, in that study, we calculated 16 common proxies of corporate tax aggression for the ASX 200. And then we ranked the 200 companies based upon their level of aggression. So from most aggressive to least aggressive. We then extracted the top 10 most aggressive and the bottom 10 least aggressive companies for comparison. Now, not one company was classified as a top 10 tax aggressive company across all 16 proxies. The best that we got was 7. So one company was deemed to be tax aggressive across 7 proxies. And in fact, most companies, or some of the companies, were both listed in both top 10 as being the most aggressive and bottom 10 as the least aggressive. So it demonstrated the fallibility of those proxies and the fact that we're not measuring with accuracy corporate tax aggression, and obviously highlighting the need for the amount of work that still needs to be done in this space. On the bright side, however, public country by country reporting is an important and hard-fought step towards complete corporate tax transparency. It will provide more information, and I'll be very interested to see the depth and quality of the information that's provided.
Any questions? I've got a small question for Bronwyn, but anyone else? So, okay. Bronwyn, just very quickly, looking at the legislation, so I presume it's stated it'll be a parent that does country by country. So I presume that's an Australian multinational, and the member of a country by country group, and I presume that refers to a subsidiary of a multinational operating in Australia.
Correct.
So we're going to get that information for Australian multinationals and for the subsidiaries of those foreign multinationals operating in Australia. But then what are we going to get for those, for the Microsofts and the Googles? Are we going to get the country by country as reported by the parent company in the US? Is that...
What is legislated is that Australian resident constitutional corporations, so basically corporations that have either a limited or a proprietary limited tag to it, has to provide country by country reporting. So if Microsoft, Amazon, whoever has a constitutional corporation registered in Australia, they are going to have to provide country by country reporting, which means information on the parent and all of the members of the group that sit underneath that.
So I presume it'll be information that the parent provides country by country in the US.
That's our hope.
Yeah, as opposed to just a subsidiary here from its perspective.
Correct. And that is our hope. And that's what Jason was saying before, that this is landmark legislation in that we'll be getting, even though it's not regulated in the US, because we have an operation in Australia, we're going to get access to the information from those US-based companies.
That will be interesting, I guess.
Yeah, I can't wait. Like, for someone who loves data, I am just frothing at the bit to get a hold of it.
But I think there'll be a lot of surprises, and we won't know exactly what it looks like until we see it. I think, Matteo, you had a question for Bronwyn as well.
Yeah, just Bronwyn, if we could articulate what's your concern with the ETR, because I know that we have here both Jason and Roman.
Yeah.
Just a bit of a background. I've worked on that for a long time, and I just want to understand your concern versus what I know their concerns were when they were working with those.
Okay, so in terms of an effective tax rate, the calculation of that is after all tax avoidance practices have taken place, right? So how can you tell? How can you tell that a company is aggressive based on their ETR? They may have a low, so if we go back to basics, a low ETR means that a company's tax aggressive, and a high ETR means that they're a good taxpayer. But it doesn't necessarily mean that. A low ETR might mean that you've and haven't been very profitable this period, that you have offset a whole heap of losses from prior periods, and therefore your ETR is low. And so it really doesn't measure tax aggressiveness. We have to be able to measure with accuracy tax aggressiveness, we need to be able to highlight these transfer pricing these activities. So we need something, a measure that occurs prior to all these transfer pricing, FinCap, BEPS activities. And until we have that, we really can't determine that effective tax rates in themselves identify corporate tax aggression. I mean, ultimately, it's the best thing we've got at now. Like, it is a proxy, it's an estimation, but it's certainly not, it's infallible. Like,
So,
Yeah,
but I can add a little bit, and I've got a PhD student, he's got a paper, and hopefully it's one we'll present SIG in AFANS, and I'll send that to you by the end of May. We've discussed the Bronwyn. But Bronwyn's correct. ETR, it does measure tax aggressiveness, but with error, because it contains a lot of accruals items which have nothing whatsoever. So us accountants would know it. Has nothing to do with tax aggressiveness. There are items there that do, and that's what we're kind of working on at the moment, is coming up with a modified ETR measure. And again, we have a paper, and hopefully we'll present it at AFANS in July. But yes, at the end of the day, I think what Bronwyn's trying to say, tax aggressiveness, we have theoretical definitions, but essentially it's unobservable. You know what I mean? So you can't directly observe it. That's why we use a lot of proxies, and measuring things like transfer pricing is obviously very, very difficult. We don't have access to that data. And yes, ETR therefore is the best. And interestingly, you know, the minimum global tax thing, which was supposed to have already happened, but it hasn't for various reasons, they're going to have ETR as their main proxy for it all. You know what I mean? Which would have been obviously problematic, and will be if it ever comes into being. But yes, ETR is not perfect, but we are working on it. And yes. Questions. We have a couple of questions in chat. Sorry, I'll just have a look. Shareholders want further financial information. They can vote for it. Notably, when these measures got put to a vote at Amazon, Microsoft, AGM, less than. Would you know anything about that? Because Jason had a lot to do with the Amazon stuff. So the question is, I guess, if shareholders want additional tax information from the board, they can ask for it, but it's not that simple. I guess you'd need the majority. So can you talk a little bit more about, because Jason's actually, he doesn't just do work with Australian corporate tax, and obviously we can all tell from the accent he's American. So he's done a lot of work with corporate tax and avoidance in the US. Can you tell us more about that, perhaps how to get things through AGMs with respect to tax matters in the US?
Sure. So we filed a landmark resolution at Amazon, which the company challenged and tried to get the US Securities and Exchange Commission to throw out. And we had the Securities and Exchange Commission with backing from investors with $3.6 trillion in capital, supporting our effort to get that voted on by shareholders. So the SEC, for the first time ever, backed a shareholder resolution around tax issues. So that's that. Previously, they had been tossed out, and we changed the opinion of the Securities and Exchange Commission to allow that tax resolution to go forward, despite Amazon's best efforts to have it thrown out as quote unquote ordinary business. So we did get.
So we're giving, so the person in chat has given examples that it doesn't require necessarily a 50%. I think removing Bezos wasn't 50%. So are we aware of anything in the US where shareholders actually want more tax information to judge whether, I mean,
it was a remarkable result. So I can't remember, we've done Amazon followed by Microsoft and Cisco, and we reached 27% of shareholders for voting in favor of this resolution as a first-time resolution. That is remarkable. That shows a growing groundswell of support amongst shareholders and investors to actually have that data.
Was that enough to get something done?
Well, no, it's not enough to mandate the company to change its behavior, but it shows increasing support. And we'll see, there'll be resolutions this year again at Amazon, and resolutions have also been filed at Chevron, Exxon, and ConocoPhillips, and there'll be a few more that we'll see as well. So we'll, shareholders take time to understand a resolution. And there's a growing awareness of this issue as important to shareholders in Europe, and that awareness is now spreading into North America as well. So I think we're going to see ever increasing shareholder support for these resolutions. How can you be a shareholder in a company like Amazon and not have information on which country it's actually making money in, revenues, losses, et cetera? It's not just the tax issue. It's about understanding a company's business strategy and whether that business strategy is based on gaming the tax system or whether it's based on innovation and creating new models and new products and new services that consumers want.
Thanks, Jason. Bronwyn, I know you've got to leave. I was going to put another question about intangibles, but we may not have.
I can quickly address it, but I've got to start teaching at
That's okay.
6.
Yeah, just give us a few minutes, and then I might add stuff. So may Ross and Jason. And yeah. Seb has a question. So Seb, if you don't mind, let Bronwyn just add a bit about intangibles because she has to leave, and then we'll go back to Seb with the question. Thanks, Bronwyn.
My pleasure. So in terms of the developments in intangibles in the tax space, it was obviously flagged in the 22-23 budget in that proposed multinational tax integrity package. And in that package, it proposed a new rule limiting multinational entities' ability to claim tax deductions for payments relating to intangibles and royalties. And that if they ultimately lead to insufficient tax paid or tax minimisation. So this proposed rule was deemed to be consistent with actions taken by other jurisdictions to address base erosion and profit shifting relating to intangibles and royalties. Now, on the 31st of March of this year, the Australian Treasury introduced the exposure draft for the Treasury's Laws Amendment Measures for Consultation Bill with relation to deductions for payments relating to intangible assets connected with low corporate tax jurisdictions. So that exposure draft specifically talks about new legislation that will be introduced via an anti-avoidance rule. So where tax deductions for payments that significant global entities make to their associates, whether directly or indirectly, in relation to exploiting intangible assets connected with a low tax jurisdiction, their deduction will be denied. So the meaning of exploit set out in the exposure draft in section 9 includes using the intangible asset, marketing, selling, licensing or distributing the intangible asset, supply, receipt or forbearance in respect of that asset, exploiting another intangible asset, or basically doing anything else in respect of the intangible asset. In terms of a foreign country that's in a low corporate tax jurisdiction, it's going to be, well, it is defined as a country that has a corporate income tax rate less than 15% or 0, or if the foreign country is determined under subsection 3 to provide a preferential patent box regime without significant economic substance. So that anti-avoidance rule is expected to apply to relevant payments made on and after the 1st of July 2023, and the consultation period for that exposure draft closes on Friday as well. So rush to get those submissions in.
Thank you.
Thank you very much for having me at the webinar. If there are any questions, please feel free to email me or contact me at QUT or through Roman. I'm more than happy to talk to anybody about this. It is a passion of mine. but now I have to go and teach some undergrad students. So I wish you the very best, and thank you very much for having me.
Thanks, Bronwyn. Okay, Seb. Sorry, Seb, you had a question?
No, that's perfectly fine. Thank you. I hope you can hear me. So I had two questions. So first question was on the, maybe one for you, Jason, like what level of pushback do you anticipate in Australia? I know you said that probably companies will turn into advocates for public CBCR elsewhere. That makes sense, but I was wondering if before that happens, will they have scope to dilute the public CBCR in Australia? And yes, so that was my first question. And my second question was more of a comment. So, I mean, I work for the PRI, so Principles for Responsible Investment, and we're trying to help investors integrate tax into their investment decisions. And the number one red flag I would say that investors have been using so far is the effective tax rate. And so I'm hearing, I'm increasingly hearing, and including from Bronwyn today, that it might not be the best proxy to use. So yeah, I'd be curious to know like what proxies can investors use, and especially the one thing to bear in mind with investors is that they don't have a lot of time, and they've got 10 other ESG issues that unfortunately take precedence over tax, like climate, for example. So don't know what the answer is to that. So that's more of a comment.
Thanks, Seb. So Jason, I might get you to answer, Seb, about what you think the eventual outcome will be and what pressure, what lobbying there'll be from the corporates about country by country, public country by country. And I'm happy to answer, Seb, again with respect to ETRs, because as I said, it's kind of, our big research area at the moment. But yes, Jason, you want to address the...
Sure, yes.
Jason's been putting submissions and for many, many years about country by country. So,
yep, and one of the things that we've continually asked for is to make it a condition of public contracts as well, prior to this being mandated for all multinationals. So we think that's a much better solution, but governments should and could require compliance with GRI for receiving government contracts as well. So I am relatively confident that the legislation will move forward, hopefully as is, and perhaps with a few tweaks to sort of clarify and strengthen it. So one of the things we've asked for in our submission is to make sure that it's in a machine readable format, so that it's easy to analyze. And over a few years, this will be an incredible data source to analyze company behavior for anyone, anywhere in the world. I think a 1 year off data might not tell you a whole lot, but 3 years of data and more will tell you a whole lot. I did attend a tax roundtable hosted by Treasury a few weeks back, and most of the room was representatives from industry representatives representing business and accounting firms and others. And I was pleasantly surprised by the relative lack of pushback in that audience. I think that most people have basically accepted that greater transparency is coming. And I think that Australia has done this, following the GRI tax standard in a way that makes a lot of sense. So I'm optimistic that the legislation will move forward more or less as is. We have some concerns about exemptions and want to make sure that any class of entities or any individual entities getting exemptions are as restricted as possible, and that there's full disclosure and transparency around who's getting exemptions and why they're getting exemptions. Not saying that exemptions may be necessary in some circumstances, but wanting to have greater transparency around that. And just given the makeup of the Australian Parliament, the government has the votes to pass this, and I am very confident that this measure and other measures will have the support of the Greens and the rest of the crossbench as well. So it's possible that the opposition supports this legislation as well. But even without that opposition support, it has the votes to pass.
Thanks, Jason. And Seb, just to give you a bit more information as well. None of this, because it was information which was previously considered private, because this will work from what I can see in the legislation. It'll work in a similar way to the current ATO disclosure regime. I don't know if you're aware, where companies have had to, for about 5 years now, disclose their tax income, tax payable, taxable income, etc. Now that we've done quite a bit of research on that. That's not perfect either, but again, it's better than nothing. And we've advocated for additional disclosures to that regime. So I think, as Jason said, I think it's a world first. So it'll be good just to get this off the ground, and we will do some research to see if it's useful or has information content, as we call it in accounting research. We'll be able to sort of test that maybe in a year or two after we have a couple of years worth of data. But yes, I mean, it's not perfect, but because there are those privacy concerns that the ATO has. They always have to weigh those, and corporates obviously, I mean, it'd be great if we have public access to their tax returns, then we'd have all the information. But yeah, I guess that's not going to happen. Now, with respect to ETR, it is the best proxy we have, and as I said, an actual tax aggressiveness or avoidance is unobservable. ETR is the best proxy we've had, both what we call a GAAP ETR, that's an accounting-based ETR, and the cash ETR, which is based on tax paid. GAAP ETR is based on tax expense. It's been the most widely used. As you said, it's used by investors, it's used by analysts. It was going to be used as part of the minimum global tax stuff, and as far as I'm aware, whenever that comes through, it'll probably be used as well. The problem, as I said, because I mean, GAAP ETR in particular, that's an accruals-based measure, or accruals accounting-based measure. So it has items which have nothing to do with tax avoidance. So, and we've just sort of started doing that research in terms of trying to tease out from that. The problem in Australia in particular, you've got to hand collect the data because it's not available in databases, and that takes a long time. But what we'll do is, and I'm happy to send you the paper if you send me your details, and we will certainly try to publish the paper in academic journals and then in the media to let people know what we think is a better measure, and we'll call it an adjusted ETR. We've actually done some research with super funds because they also have similar problems, and we've come up with an adjusted ETR for super funds, and hopefully that should be published soon as well. But yeah, look, I don't think we're going to get too much better than an ETR. I mean, I'd love to have specific measures of, transfer pricing, but that's not going to happen. So yeah, look, stay tuned. If investors ask you, I mean, you can tell them ETR is the best, but they need to be very careful. And as I said, hopefully we'll publish some new research this year, and maybe investors, analysts will start using that as well. Okay. Does that answer your question, Seb?
Yeah, absolutely. Thank you very much, both. Very helpful.
Look,
and I'll send you my details. Yeah.
Send us your details. Look, I think we'll probably, if you can, we'll go 5 minutes over time, and I want to get to Ross and PRRT, which is probably even more exciting and has huge potential for revenue raising. So Ross, because Ross actually did the report when we worked with GetUp together and presented that report before the Senate inquiry 5-6 years ago. So Ross, can you tell us exactly what PRRT is and what the problems have been so far and how it could be improved potentially? Because it seems like the government is finally onto that.
Thank you. With the Petroleum Resources Rent Tax, the introduction of a rent tax was actually a very good move, because previously we had royalty regimes, and royalties are rather regressive. They apply taxes regardless of the profitability of the operation. So therefore, they kind of will deter investment in certain areas. Whereas, however, so therefore, when they introduced the resources rent tax back in the 1960s, Australia had no known reserves of petrol, and it was mainly about the oil rather than gas was not thought of at the time. Now, with the application of the PRRT to gas, there's a couple of major issues that come into it. One is the nature of gas production. It requires huge amounts of upfront costs involved in setting it up, which is something that petroleum oil production doesn't require. So therefore, in order to get the gas up and running, there's huge costs accumulate. Now, the problem with that is not so much that they have these huge costs, it's that they can have this thing called an uplift rate on the PRRT, which is for exploration costs is 15% plus the bond rate, and for production costs it's 5% plus the bond rate. Now, if the bond rates had stayed at 1%, you were looking at doubling the value in 5 years of your costs. Now, because the costs are taking 8 years to get some of these operations up and running, their initial costs, their exploration costs, have already more than doubled by the time they start producing oil to produce a profit. And so therefore, they're having issues, and that's why Australia's revenues from the PRRT are so much lower than comparable other countries. Like Jason mentioned, we've got we're the biggest producer of natural gas anywhere in the world now, and yet we're receiving far less in resource rent taxes than any other country, than any comparable country. So that's one thing. That's the main problem with it, is this uplift rate. And the second one, of course, was that they can transfer these costs between projects, which means they're loading up certain projects, profitable projects, with lots and lots of costs from other projects. So they're loading it up in two ways in order to kind of keep because they'll only pay any tax on profits over a certain amount, and they start paying 40%, which is pretty big. So therefore, there's a big incentive for them to load up with costs so that they never actually start paying any kind of tax on it. Well, that's how it seems to be going. It will, supposedly, in the long run, we'll start getting higher rates of tax on it. But by then, the gas will probably run out, or the demand will have dried up, because we'll have moved on from gas. We're looking, 20 years in the future. So look, that's pretty much it about the PRRT. I'm not sure, I haven't read up on what the government's proposing currently, the current changes. Okay, but that's just a little bit of background on the PRRT.
And we know they haven't paid much, because they do have to disclose that as part of the ATO disclosure, so you can actually see what these companies have contributed, and it's not much. Maybe to finish off, I'll get Jason maybe to finish off in terms of what the government is, what you think maybe how they'll change the PRRT to get revenues flowing, because gas prices are astronomical. They are producing now and have been for a while, I think for at least a couple of years. Those gas fields came online. So what's, have we had any sort of, I know it's just came up, but have I changed things?
Yeah, so let me just first say that we did get some reforms out of the previous government in relation to PRRT, and that they did reduce some of the most egregious aspect of the uplift rates that Ross was talking about. So they did reduce those uplift rates, but the industry had hundreds and still has hundreds of billions of dollars in PRRT credits on the books. So that's a huge buffer for them paying any PRRT for some years to come. The previous government made those reforms and then kicked the biggest reform down the road into a Treasury consultation, where it's been stalled ever since. And now Treasury has apparently produced a paper that's been sent to the current treasurer, and he's looking at that. And so I very much believe that what we'll see there is a change to the gas transfer pricing mechanism within the PRRT, which basically will move Australia to one set standard, which is simplifying, increasing transparency, and it's basically a net back only approach, which is what the OECD recommends as the best standard in terms of this kind of related party transaction, because the PRRT applies to the raw gas and not the sale of the LNG. And what the companies will argue, because they're allowed to under the current regulations, is that essentially the resources that they take from offshore Australian waters have very little value, and that the value that they get for the LNG, and as Roman pointed out, the prices are sky high ever since the Ukraine conflict. It's not priced at the sale of the LNG, it's priced at the raw gas, and that's an internal sale within the companies. So we think that what they'll do is restrict it to one method, which allows, less gaming of the system with these related party transactions of the sale of the raw gas as extracted before it gets turned into liquefied natural gas and then exported. And we know in 2022, the value of exports of LNG from Australia was about $93 billion. And these projects are currently paying absolutely nothing in PRRT. We are getting small amounts of PRRT from old projects in Bass Straits, but the lifetime of those projects is not long, or has been long, but is about to end, to be more clear. So the Callahan review of this estimated that, under older, lower world gas prices, $90 billion in revenue over the decade from changing to a net back only approach on the gas transfer pricing mechanism. So that's what we're hoping to see. We have pushed for broader reforms, including an additional 10% royalty on offshore gas, but I'm not going to hold my breath on that one, but I do think that we'll see movement on the gas transfer pricing mechanism.
And I think that what you're talking about is similar to what they have in Canada with the transfer pricing, and that's why they collect a hell of a lot more in those resource rent taxes than we do. Okay, it's quarter.
Yeah,
sorry.
can I just have one more thing? I just wanted to, there was a question from Greg about Apple's ETR.
Yes.
A lot of that 16% he's talking about, when the US tax rate is actually 35%.
It's a consolidated ETR.
It's a consolidated one about, that's their global tax. Now, along with most US information technology corporations, they pay all the tax that they need to in the US, that they're required to pay. They just don't pay any tax anywhere else in the world. And the US government seems very happy with that situation, because it seems to think the rest of the world, the money that makes the rest of the world is actually
and Greg, that's how they get a low consolidated ETR, because they may pay their full tax in the US. But remember, with the US multinationals, 50% of their revenues come from overseas, and those set up in Europe are usually set up in Ireland or something where the tax rate's a lot less, and they can permanently reinvest. They don't have to bring the profits back to the US. So that's what gets the consolidated ETR a lot less than the corporate rate in the US. Any final questions before we finish? Any final questions from anyone? All right, fantastic. Well, I think we just a few minutes over time, but it's been very educational, hopefully for everyone. Thank you, Jason. Thank you, Ross.
Thank you.
We've got David here, our tech person, and everyone else. Any other questions, guys, that you have, please don't hesitate to email me. If you'd like, if you have ideas for webinars, as I said, we're happy to consider them, but and stay tuned for any new webinars that we'll be putting on. But other than that, anything else? Thank you, Seb. Thank you, guys. Hopefully we'll see you next time.